Hello everybody, this is Dr. Wright. Welcome to online module number 7 for ManEc 453. Today we're going to be talking about how to execute Monte Carlo simulation in the context of the discounted cash flows model. Locating ourselves on the map, you can see that we're in the 7th module here, learning how to do simulation analysis in the context of the discounted cash flows model. In the previous 2 modules, we built up a simple version of the discounted cash flows model, and then we learned how to turn a lot of those inputs into dynamic inputs so that we wouldn't have to go out and collect the data by hand. Today, if you look at our Excel training and review objectives for the online portion of the course, today we're focusing solely on Monte Carlo simulation. So our goals for module number 7 are, first off, we want to allow certain inputs in our discounted cash flows model to be randomly drawn from a defined statistical distribution. We also want to estimate multiple iterations of the discounted cash flows model with distribution-based inputs. And then lastly, we want to create a histogram of possible fundamental values based on the simulation analysis conducted as described in the previous 2 bullet points. So the deliverables might look a little bit intimidating, but I'll walk you through it. Ultimately, what we want to do today is, instead of reporting a single estimate of the fundamental value, we want to provide a distribution that shows our end user what we think the range of possible fundamental values might be. And then, based on this histogram of what we think the possible fundamental values are, we'll be able to make a decision based on what that graph looks like relative to the current price of the stock. So I don't want to spend any more time on the PowerPoints. I want to dive right in. Now, before we start, you're going to need to get Monte Carlo simulation software. I'm going to be demonstrating everything today using RiskAmp. So if you just go to google.com, type in RiskAmp and download, then one of the very first things that should pop up right here is RiskAmp, and it gives you the opportunity to download RiskAmp. Now, one of the nice things is, if you go to the RiskAmp homepage, you can download a free trial version of this RiskAmp add-in. There are a lot of different Monte Carlo simulation software available, and the reason that I picked RiskAmp is because this is one form of the software where you shouldn't have to pay any money. You can do everything we need to do with the free trial that you can get online. So what you need to do is go and download this free trial version of RiskAmp, follow the directions, and what will happen is you'll see a new tab up here. So we have the Fred tab that we used in our previous module. Now we'll have a Monte Carlo tab. And I want to try to demonstrate to you this Monte Carlo simulation using a slightly different context, and then we'll apply it to the discounted cash flows model. So imagine you had a beginning investment value of $10,000, and you were considering investing it for 20 years. And you might say to yourself, well, what's my average return going to be? And maybe you'd think, oh, maybe it's going to be somewhere around 7.5%. And then you might want to know, okay, what's my predicted ending value? Well, you could just use the time value of money function here in Excel. There's your rate, there's your time period, there would be no payments, and your starting value would be this $10,000. Sorry, I put in 100, I meant 10. So if you started with $10,000, invested it for 20 years, and earned 7.5%, you would earn $42,478.51. In essence, what you're doing is this. So for 20 periods, let me just scroll this down to 20 periods. What you're doing is you're saying this, okay, I'm starting with 10,000, and I'm going to get this return, 7.5%. So my ending value is just going to be my beginning value times 1 plus that return, and then my beginning value the next period is just that ending value from the previous period. So once you have that, that can just be copied and pasted down, and then if you just copied and pasted the formatting and made it look like that, this is essentially what you're doing. So up here, you're starting with 10,000. Every period, you're earning 7.5%, and you're ending with $42,478.51. Now, all of you are familiar with that. The problem with this is, how likely is it, honestly, that over the next 20 years, you're going to earn 7.5% every year? And the answer to that question is the probability is 0. You're not going to earn 7.5% every year. What's more accurate is to think of it this way. You're investing money perhaps in an instrument or a market that tends to earn 7.5% per year, but it has variance, it has standard deviation, and it's probably similar to a normal distribution. So maybe if you're putting it in the stock market, it has an average return of 7.5%, but it also has a standard deviation of, say, maybe 5%. So it's not really that you're going to get 7.5% every year. It's that you're going to get something that is going to have an average of 7.5% and a standard deviation of 5%. Well, this Monte Carlo software is going to allow us to incorporate that type of thinking. So instead of saying that we're going to have a return of 7.5%, what we can say is this. Let's draw from a normal distribution using the normal value formula. And then all you have to do is give it the mean and the standard deviation. Now when I hit the enter button, what's going to happen is Excel is going to go and draw a number from a normal distribution that has a mean of 7.5% and a standard deviation of 5%. I'm going to copy and paste this all the way down. Now, just to prove to you that it's probably going to have an average close to 7.5%, let's go ahead and calculate the average over our 20 years. And let's also calculate the standard deviation. Okay, so you can see now what we have is, instead of assuming we're going to earn 7.5% every period, we're actually drawing from a normal distribution. And this looks a lot more like reality. We're losing money the first year. We're only gaining 1.37 the next year. We have a couple big years. We also have some other modest years down the road. That looks a lot more realistic. And ultimately, it has an average return close to what the stock market has done and a standard deviation close to where I want it. But here's what you can do with Monte Carlo simulation. You can repeat this process hundreds of times. So for instance, we could say, well, why don't we do this again? Let's do this experiment again, and let's pull all 20 of those numbers again from a normal distribution with a mean of 7.5% and a standard deviation of 5. So you can do something like this. You can do a bunch of iterations. And maybe we want to do 10 iterations. Actually, you'd want to do more, but just for the sake of showing you, let's just do 10 iterations. And then we can actually say, what's the ending value in each iteration? And all you do is this. Okay, simulation value. That's the formula. Then you have to click on what output you really care about. Well, what we're doing here is we're going to repeat this experiment 10 times, and I want to see what my ending investment value is each time. So what I'm going to do is this. Let me go back just a second. Up here, I'm going to link my ending value down here to the table. And then I'm going to leverage on this simulation value formula. I'm going to click on that output, and I'm going to lock it in. And then the next thing you have to do is you have to tell it which iteration are you talking about. So for this row, I want to see what the first iteration gives me, and then we'll drag it down and we'll be able to see what all 10 iterations shows us. So I'm just going to drag that down. And now what we can do is we can go up to Monte Carlo tab. We can run a simulation, and we're just going to do 10 iterations. So we do it, and you can see the screen updating. And let's go ahead and turn that into dollars. So what happened is 10 different times, Excel drew these 20 returns from a distribution, a normal distribution with an average of 7.5% and a standard deviation of 5%. When it did it, that's the outcome that we got. That's very informative. So first thing is we can do this. Let's figure out what the average was. Let's figure out what the median is. Let's figure out what the minimum is, the maximum, and the standard deviation. So let's just do average very quickly here. Let's do median. Let's do min. Let's do max. And let's do standard deviation. So what I'm trying to show you is by doing the Monte Carlo simulation, we're doing a much better job of modeling reality. Instead of having 7.5% as our return every year, we're just drawing this from a normal distribution that has similar attributes to what we've observed in the stock market. When we do that 10 times, when we run that experiment 10 times, we get an average ending value of $43,400. We get a median of 41,000, a minimum of 33, and a max of 57. Think of how informative that is. So we know if we put our $10,000 into an investment that looks roughly like the stock market, and don't hold my feet to the fire, I'm guesstimating on some of the numbers I put in there. But if we put our investment into something that has a distribution that looks like this, then we can expect after 20 years to have somewhere between 33 and 57,000 with an average of $43,000. That's a lot more informative than coming up here and running a simple future value function and giving us one static number. This gives us a much richer picture of what we can expect if we actually do this investment. Now, there's one other feature in Excel that I want to try to demonstrate to you. And in order to do that, I'm just going to do this. What if you have your money in bonds and treasuries? And so up here you might do something like this. You might do bonds, treasuries, and you might have to put in an average and a standard deviation. So maybe on average bonds have earned 5%, and maybe they have a standard deviation of 2%, and maybe on average treasuries have earned 4.5% with a standard deviation of 1.5%. Look, I made those numbers up. I'm just trying to demonstrate something to you. Well, what if you want to do the same thing? What if you want to do period 1 to all the way down to 20? So you could do this. You could say, all right, normal value. There's my mean. There's my standard deviation. I could lock in the 2 and the 3, and I should be able to drag that formula over like so. Format it. And then down here, just prove to ourselves that we're comfortable with what we did. So let's calculate real quickly the average. And the standard deviation. And you can see we're a little bit off, but we're in the ballpark. But here's the problem. When you do this, these two series of returns are statistically independent. In other words, the correlation is assumed to be 0. But we know for a fact that treasuries and AAA rated corporate bonds have a very high correlation. So it would be a mistake to do it this way and to assume a 0 correlation. What you actually need to do is take into account that correlation. Well, this Monte Carlo software has a way for you to do that. And how you do it is like this. So what you have to do is you have to come up with a correlation matrix. So you have to create a matrix that has the correlations. Well, the correlation between bonds and bonds is 1. The correlation between treasuries and treasuries is 1. You actually don't have to worry about the upper part of the matrix. You just need the lower part of the matrix. Well, it turns out that bonds, AAA rated bonds and treasuries actually have a very high correlation. It might be as high as 0.75. Now let me just demonstrate to you. I'm going to calculate the correlation down here. So here's correlation function. So here's the first array, and let's correlate that with bonds. And you can see that the correlation is almost 0. But that's not accurate. We know that these are actually highly correlated. So when treasury yields are high, AAA yields should be high as well. So instead of using normal value, we're going to use a different function. It's multi normal value. And you start off by telling it what cells need to be correlated. So for us, it's these two cells right here in the same period. It's L10 through M10. The next thing you have to give it is the correlation matrix. Then you give it the mean and standard deviation just for this variable. So that would be for the bonds, the mean and the standard deviation. Now we need to lock some things in. Specifically, that L and the M need to be locked in. And the correlation matrix, the entire correlation matrix needs to be locked in. And the numbers up here for the mean and the variance need to be locked in. If we do that, we can copy and paste the formula across. Let's dissect it to make sure it looks right. Multivariate normal, or multi-normal value, sorry. We've told it the two cells that need to be correlated, L10 and M10. And we've told it the correlation matrix right here. And we've told it the mean and the standard deviation, M2 and M3. Now, we should be able to drag that down. And watch how it changes. So our averages and our standard deviations still look right, but now we have a correlation. And that's what we want, because in reality we know that bonds and treasuries are correlated. So I wanted to show all of this to you in a very simplified context. Now what I want to do is I want to go to our discounted cash flows model, and I want us to take just a couple variables and turn them into these distributions, so that instead of having a static input, we're going to have a dynamic input drawn from a distribution. Then we're going to do a bunch of iterations, and instead of getting one fundamental value estimate, we're going to get a whole bunch of fundamental value estimates, and we'll draw a histogram, which should be super informative for us as we try to make our investment decisions. So let's come over to our work from the last two Excel modules. What I've done is I've looked at the inputs and I've tried to highlight the variables that I'm very worried about. In other words, these are variables that we put in. We had good logic for the data that we used to get these inputs, but if we're honest, these are raw estimates. We are not sure at all that we've got the right estimates for these numbers. I don't honestly know if I can count on last year's cash flows to be representative. In other words, I don't know if that's the right launching point from which to start my model. I'm also really worried about this year one growth rate, and I'm very, very worried about the steady state growth rate. For me, those are all variables that are candidates that probably should be turned into distributions. We should draw those from distributions as opposed to having a single input. Cost of debt. Again, we had good logic, but I'm not at all confident that that's the true cost of debt over our investment horizon period. And if you think about it, we're trying to forecast, and it's very hard to do. And so it's better to just draw from a distribution as opposed to use one static input. Same thing with the risk-free rate. I'm not confident that that's exactly what it's going to be for the next 20 or 30 years. I'm worried about the beta, and I'm worried about the equity risk premium. Now look, I'm not, in this Excel module, going to show you how to turn all of those into distributions. But from what I showed you previously, you can see how to do it. You can see the process you would go through to turn these variables into distributions. I'm only going to do it for a few of these variables. The first variable I'm going to do it for is the year zero free cash flows, just because it's so important. So if you remember, what we did for the year zero free cash flows is we went and got the free cash flows to the firm over the last 5 or 6 years. Now, we're limited by what's actually available online. So for ExxonMobil, we can only go back 4 years. So that number becomes my launching point for year zero free cash flows, but they've had high volatility in their cash flows. So I'm not terribly confident that that's the right place to start. I'm going to call that my mean. That's my best guess. But I'm also going to generate a standard deviation. Now, how am I going to do the standard deviation? Well, you could do this. You could do standard deviation of the actual data up here. But for me, that's a massive standard deviation. So I want you to use your judgment. If you do that for your company and you get a reasonable standard deviation, then go ahead and use it. But that's just way too big for my purposes. Now, why am I saying that's way too big? Using the 68, 95, 99 rule, there's at least a reasonable probability that I would get negative free cash flows to the firm, and I don't want that. So what I'm going to do is I'm actually going to divide that in half just to give me a more reasonable standard deviation. So then what I'm going to do up here is, instead of just linking this to my year zero free cash flows, I'm going to turn this into a normal value. So we're going to pull it from a normal distribution. I'm going to use the last cash flows as my mean, and I'm going to use this number that I concocted as my standard deviation. Now, I should give you a little bit of a warning. Some people would be very bothered by what they're watching me do. There's not a lot of science, but then again, keep in mind, when it comes to financial models, there is some science, but there's also a lot of art to it. When I came up with this standard deviation, I was using my judgment. There was a lot of art going into that, and I admit that. But you can see now, anytime we do an iteration with this model, we're going to get a number that's drawn from a normal distribution with a mean of 24.7 billion and a standard deviation of 7 billion. All right, again, I'm really worried about the year one growth rate and the steady state growth rate, but just for the sake of time, I'm not going to turn those into distributions. You see how you could do it? You'd have to think a little bit about what your mean and your standard deviation would be. Now, these numbers that we got right here would probably be good candidates for your mean. What you'd really need to think about is what's my standard deviation going to be. But let me come down here, and I actually want to turn the cost of debt and the risk-free rate into distributions. But remember how I showed you that the yield on bonds and treasuries is highly correlated. So we're going to need to do something like this for these inputs. In other words, we want those to be correlated because we know in real life they are correlated. Okay, so here's what we're going to do. We're going to go back to our cost of debt spreadsheet, and you can see that I've added some information here. We're going to fill it in. The first thing I want to do is I want to aggregate onto this spreadsheet all of my data about AAA, BAA, and the risk-free rate. So let's go ahead and get the average yield on the AAA bonds. Now these are in integer format, so we're going to divide it by 100 to get percent format. So we're going to take the average yield, divide it by 100, and that's what the average AAA yield has been. Let's also get the standard deviation of that, divide that by 100, and let's do the same thing for the BAA bonds. So average for the BAA bonds, we need to divide that by 100 and get the standard deviation divided by 100. Okay, I also want to get this for the risk-free rate. So let's go up to our risk-free rate page, and I'm just going to take the average of my risk-free rate and divide it by 100. And I'm going to get the standard deviation from that same data. So there's the risk-free data, divide it by 100. Okay, so we have our averages and our standard deviations, but now we're going to need correlations. Now remember, we've given ourselves a choice on the inputs. We can either use AAA or BAA bonds as our cost of debt. So we're going to need to figure out the correlation between both AAA and the risk-free rate and also BAA and the risk-free rate. We know that the correlation between AAA and AAA is 1, and the correlation between the risk-free rate and the risk-free rate is 1. What we don't know is the correlation between AAA and the risk-free rate. So we have to go to the other tab and highlight the risk-free rate. And we can see, look at how highly correlated AAA bond yields are with the risk-free rate. So again, I just want to remind you, if you made the mistake of just turning these two variables into normal distributions without accounting for the correlation, then you would end up with variables that have a 0 correlation. But in reality, they have a correlation of 0.93. So your model would not be accurately depicting reality if you didn't capture that correlation. Okay, we need to do the same thing for BAA. We know the correlation there is 1, the correlation there is 1, but we need the correlation between BAA and the risk-free rate. And there it is. Now you can see BAA is not quite as highly correlated with the risk-free rate as AAA bonds are. But okay, now let's come back up here and let's turn this into a distribution. So what we want to do is multi-normal value. And the two cells that we need to be correlated are B17 and B18. Now, I'm going to start off assuming that this is a AAA bond. So we need to give it the correlation matrix right there. And we need to give it the average and the standard deviation. Okay? But here's the issue. It could be AAA or it could be BAA. So what we want to do is this. We want to say if that cell equals AAA, then we have what we want. However, if it equals BAA, then what we want is multi-normal value. We still want B17 through B18, but now our correlation matrix would be down here. And our average would be the BAA and the standard deviation would be the BAA. Okay, so we're going to want to do the same thing here. We're going to need to use an if-then formula. We're going to say if that equals AAA, then we want multi-normal value. And again, we want B17 to be correlated with B18. If it's AAA, then that's our correlation matrix. And the average is now the risk-free average, and the standard deviation is right there. However, if it's not AAA, if it's BAA, then we want multi-normal value. Again, B17 to B18 is where we want the correlation. This now becomes our correlation matrix. And again, there's our average and our standard deviation. All right, so now what we've done is we've made it so that when we do several iterations, these two variables will have these distributional properties. They'll have those averages and standard deviations with those correlations, which is exactly what we want because that's what we see in reality. And the closer we can get our model to align with reality, the more reliable the output will be for us. Okay, now again, I'm worried about beta and I'm worried about the equity risk premium, but just for the sake of time, I'm not going to show you how to turn those into distributions. But this gets back to the same point that I made up here for year one growth rate and steady state growth rate. Those probably represent your best guess at the mean. What you need to think about is what would be a good standard deviation if I wanted to turn these into distributions. I'll let you put some thought into that, but I'm only going to show you how to do that and that. So now what we want to do is we want to actually execute Monte Carlo simulation. In order to do that, I'm going to get a new tab. I'm going to call it simulation. And what I'm going to do is I'm just going to write up here my iteration, my fundamental value, and mispricing. And let's do 500 iterations. So if you just put one there and you come over here to fill series column to 500. So if you type that in, click OK, it'll fill it in for you. Now for the fundamental value, this is where we have to use our simulation value formula. Go get the output that you want, which is the fundamental value. Lock that in, and then tell it what iteration you want. Well, we want the first iteration. And we'll slide that formula all the way down. We'll do the same thing over here, simulation value. Except this time, let's go get the mispricing. And again, we want that as our iteration. Now remember to lock in your output variable. Shoot that all the way down the line. Now, here comes the really cool part. If you go to Monte Carlo, run simulation, put in 500 iterations, then what it's going to do is for each of the variables that we turned into distributions, it will do 500 iterations. So it will draw those variables from the distributions that we defined 500 times, and we'll get 500 different fundamental values and mispricings, which will give us a much richer set of information from which to make our investment decision. This is going to take a little bit of time, so let's start it and let it rock and roll here. Okay, and so once it finishes, you'll see that literally it's given us 500 iterations of our discounted cash flows model. So format it so that you understand what you're looking at. So what that means is, in the first iteration, Excel went and pulled these numbers from the normal distributions, and these two actually had a correlation of whatever we told it to be. So those three numbers got pulled from distributions, and when it ran that first iteration, it got a fundamental value of $33.69, which suggests that the current price of the stock is overpriced by 63.28%. But you can see it went through 500 iterations of this. So the next thing we want to do is just collect some data to help us interpret the output and decide what we want to do here. So let's do this. First off, let's remind ourselves what the ticker is. So let's go and get the ticker. And then let's do this. Let's do average, median, let's do min, max, and let's do standard deviation. And let's move that down one. And let's do it for both the fundamental value and for the mispricing. So let's get the average, fundamental value, and the average mispricing. Let's get the median. Let's get the min. And let's do it for the mispricing as well. Let's get the max. And let's figure out the standard deviation. And then, excuse me, I'm gonna cut ahead. I'm just gonna format this a little bit, but you don't need to watch me format. And once we have it formatted like that, let's go ahead and just put on here, since it's easy enough to do, let's put on the current price, and we'll just use our RCH get Yahoo quotes function, if I could spell it correctly, get Yahoo quotes function, and go get our ticker symbol, and remember to get the last price. We just need L1 like so. All right, so right there, I think we have a much more complete information set from which to start making our investment decision. Right now, the current price is $91.73. When we do 500 iterations, the highest price we get is $135. The lowest we get is -36. Now, that's obviously nonsense. You can't get a negative price for a stock. If we wanted to, we could go in and play with it and truncate that at 0, but I'm actually just going to leave it. We can see that the average is $51.76 and the median is $50.94. So based on the information I'm seeing here, I'm not optimistic about wanting to buy this stock. What I would like to do, though, is to actually draw a histogram to give me a little bit more information. So what I'm going to do is this, I'm going to create 21 bins. So we make 21 bins, and what you have to do is you have to make breakpoints in your bins. And then what we have to do is count how many of our observations are in each bin, and then we'll get the percentage of our observations that are in each bin. So the hardest thing is we have to come up with breakpoints. And one thing that I'm going to have us do is actually this: number of standard deviations to span. So what I'm going to say is, from our lowest breakpoint to our highest breakpoint, how many standard deviations do we want to look at when we draw the graph? Why don't we start out with 2? So what I'm going to do is this: to get my lowest breakpoint, I'm going to take my average and I'm going to subtract out the standard deviation times that number. To get my top breakpoint, I'm going to do the same thing except on the other side. So I'm going to take my average and add my standard deviation times 2. Now, if you have 21 bins, that means, and if you do it the way that I'm about to show you, this 11th bin right here should actually be the average. This is how we're going to do it. We're going to say, to get the second breakpoint, start with the first breakpoint, but add on the difference between our max and our min divided by 20. And you need to lock in, actually, the F33 and F13. So look, all we're saying is we have to go from -461 up to 108.13, and we have 20 steps to get there. So we're going to start with -461, and we know that we have to go from 461 up to 108.13, and we have 20 steps or increments to get there. So if we do that, should look pretty good. And like I said, the 11th bin should essentially be our average if we do it that way. And now what we want to do is we want to count how many of our fundamental values are in each of the bins. So what I'm going to do is this: I'm going to say count ifs, and what I want to do is highlight this range, So I'm going to highlight this whole column, and what I'm going to do is I want to count it if these fundamental values are greater than or equal to negative 461 but less than 103. So let's highlight it, comma, if it's greater than or equal to, ampersand, and then you come up here and say that. So what we've said is count it if any of those are greater than or equal to negative 461, and also it's got to be less than the next bin number. So again, highlight the column, less than, ampersand, come back up to the top, and now click on the next bin. So pick apart that formula. What we're saying is count all of these if they're greater than or equal to this breakpoint and less than or equal to the next breakpoint. Lock in the range that you're counting. Scroll down like so. And now what we want to do is figure out the percent. So we want to figure out what percentage of our iterations fall in that bin. So we'll just take that number and divide it by the sum of the whole column, and you need to lock in the whole column. Send it down the line. Now again, you don't need to watch me format, so excuse me for a second while I step away and format this. And now we can change this input. We can say, what if we want our analysis to span 3 standard deviations? We can put in 3, and that actually demonstrates to me that I made a slight mistake that you may have caught earlier. Instead of hard coding in the 2 down here in the 21st bin, I need to replace that by actually clicking on that cell right there. So now we can change that. We can say, well, what if we only want to span 1 standard deviation, 2 standard deviations, 3 standard deviations? Now the last thing I want to do is I just want to draw a histogram of this. So let's go up here and insert a column chart. All right, so we need to right-click, select data, add it. Don't worry about giving it a name. Just go highlight the frequencies. So that's the probability of having an outcome in each of our bins. Click OK. And then you want to go ahead and edit the horizontal axis, which is just going to be the bin labels right there. Click OK. Bring it up. And I like to make it a little bit bigger so that I can see it. And you might want to do something like this. Get rid of that right there. And just put right here fundamental value. And you could put histogram if you want. It's not exactly a histogram because the bars aren't touching, but it's close enough for my purposes. And if you wanted to, you could format this a little bit. I actually like to make it pop myself, so I like to do something like this. And format that with a solid fill of black. And maybe turn those into yellow just to make it pop a little bit, and then resize that just so we can see the axes a little bit better. Okay, and so now what you have is what I believe to be a very rich information set. I can't say it's complete, but it's certainly more complete than what we did previously. And what you can say is, we're not sure about all these inputs. You know, we've given it our best guess. We're not sure about all these inputs, but we turned a lot of them into distributions, and we ran 500 iterations. So we allowed these variables to change. We allowed them to take on different values. And when we did that and ran 500 iterations, this is what the outcome looks like. Now, the current price of ExxonMobil is $91.73. That would put you about right here on the graph. So you can see that almost all of the fundamental values we get from our discounted cash flows model are less than the actual price. So from what I see here, I'm becoming more and more convinced that I don't want to buy this stock, largely because all my iterations are coming in below the actual market price. So this is your assignment for the 7th Excel module. We want to turn at least those 3 variables into distribution inputs. And so you're going to have to go back and do what I did here on the cost of debt. And remember, you're going to have to take into account the correlations between the bonds and the risk-free rate. So turn those 3 variables into distributions. Then you're going to run 500 iterations. I want you to create a spreadsheet that looks just like this, that talks to me about average, median, min, max, standard deviation from our simulation analysis, and then I want you to actually create a histogram where I could change how many standard deviations we're spanning. So you can see the chart even becomes dynamic for us. So if we span 2 standard deviations, it looks like that. And again, right, the actual price is 91.73, which puts you almost right there. And again, you can just see almost all the iterations are coming in below that. Now, we could try it for a different company. I'm hesitant to do this because I haven't pre-tested it, but we could put in a company like, say, McDonald's. Hit the enter button. It's going to take a little bit of time because remember, all of our dynamic inputs are going out and scraping the web right now. Once that pops up, we can redo our Monte Carlo simulation and see how that looks. So ultimately, it refreshes everything for McDonald's. Then we can come back to our simulation. Should be able to go to Monte Carlo. Should be able to hit run simulation. Do it again. And now it's going to crank back through. It's going to re-estimate these 500 iterations for McDonald's, and we'll be able to recreate our histogram, and again try to make some inferences and some investment decisions based on this more complete information set. So I'll pause and jump ahead while it's doing the iteration, so you don't have to watch it again. And so you can see now it's cranked back through the 500 iterations for McDonald's. We see that the current price for McDonald's is $93.72. I'm getting an average fundamental value well above that. I'm getting a median fundamental value well above that. In fact, my minimum fundamental value is almost right at the current price. And so that right there is where the current price would be. Almost all of my discounted cash flows model iterations are giving me a fundamental value above that. That's a pretty strong signal. That's a pretty strong signal that maybe this is a stock we would want to look into as a possible buy. But always you'd want to go back through and look at the inputs and make sure you're comfortable with the inputs. I can guarantee you that that steady state growth rate of 5.41% is exerting a lot of influence. So naturally you'd want to go back in and turn all of those that need to be turned into distributional inputs. You'd want to actually do that. Turn those that need to be turned into distributional inputs into distributional inputs. Well, that's your assignment. Again, this is the major deliverable, but you're going to turn in an Excel file very similar to what we've seen before, but now it's going to have this simulation tab. You're going to present a histogram for us, and we should be able to take your file and do it for any stock that the data is available for out there on the internet. Best of luck with the module. I hope you feel like you're learning some powerful things here with Excel and finance. If you have any problems, come see me, come see your professor, or contact your TA. Again, best of luck.